So, for the last couple of years, the whole AI story has been about one thing, right? Software, the digital mind. We've all been pretty captivated by what these large language models can write and say and create. But what if that was just the opening act? What if today's Magnificent Seven are just warming up the stage for tomorrow's Humanoid 100? That's exactly what we're digging into today. We are going beyond the software hype to look at the companies that are actually building the physical bodies for AI. This quote right here just perfectly captures the shift that we're all witnessing. It's this fundamental pivot from the world of bits to the world of atoms. Think about it. We're moving away from algorithms that live up in the cloud, and we're moving toward physical hardware, robots that are going to walk and work and operate right here in the real world with us. This is the new frontier. All right, so here's how we're going to break this down. First, we're going to get our bearings and look at the current AI software bubble. Then, we'll dive headfirst into the physical world and see exactly why hardware is hard. After that, we'll unpack a whole new way to think about valuing this revolution. We'll tackle that huge debate over jobs, and then finish up with the $7 trillion question that's hanging over this whole thing. Let's get into it. Okay, so first things first, let's talk about where we are right now. We are, without a doubt, in the middle of an AI gold rush. And just like every gold rush in history, it's defined by these absolutely soaring valuations and a ton of hype. And honestly, there are some very legitimate questions about whether or not we're in a bubble. Get a load of this number, 110 times sales. That is an absolutely staggering valuation. Just to put that in perspective for you, a really healthy, mature company might trade at 2, maybe 3 times its annual revenue. So this isn't just optimism. This is a bet on complete and total market domination. And it's the kind of hype we're seeing all across the AI software space. And this is where the math starts to get a little bit terrifying. To actually justify these crazy valuations, Bain & Company estimates that the AI industry needs to be pulling in $2 trillion in annual revenue by 2030. And that's just to be profitable. That is more than the combined 2024 revenue of Microsoft, Meta, Alphabet, Amazon, Apple, and NVIDIA. It's a colossal number, and it really shines a spotlight on this massive gap between the investment dollars pouring in and what a sustainable, profitable future actually looks like. So you have to ask, where is all this money even coming from? Well, it turns out a lot of it is being fueled by something called circular financing. And it works pretty much like a financial merry-go-round. You have a huge tech company that invests billions into a little AI startup. Then, that startup turns right around and uses that exact same money to buy services, like cloud computing or chips, from the very company that just gave them the money. And this right here shows you exactly how that loop works. You see NVIDIA investing in a company, which then, surprise, buys NVIDIA's chips. Microsoft throws money at OpenAI, which then pays for Microsoft's Azure cloud services. It paints this picture of booming demand, but it really makes you wonder, is this real organic growth, or is the industry just paying itself to create the illusion of a boom? It's one of the key reasons some analysts are getting serious dot-com bubble vibes. But you know what? That whole financial story, as wild as it is, might actually be a distraction from the main event. So let's pivot. Let's step away from the digital and start looking at the physical. Because the real long-term story here isn't just software, it's the machines that software is going to live inside. And this just lays it out perfectly, doesn't it? For the last few years, all the money, all the attention, it's been focused on the left side of the screen, the mind, training bigger models on more data with smarter algorithms. But the next decade, that's going to be defined by what's on the right side, the body. The robotics, the actuators that actually create movement, and the sensors that let a machine see and feel the world around it. And this quote, man, it just hits the nail on the head. The popular misconception is that AI is this digital ghost that just lives in the cloud. But the reality is that making AI work at scale is a business of atoms. It needs real physical things, data centers, power grids, miles of fiber optic cables, and more, robots. And if you're wondering what that business of atoms actually looks like, well, here you go. Tesla's Optimus is probably one of the most visible examples of physical AI out there. This isn't about writing an email for you or making a funny picture. This is about creating a machine that can do manual, repetitive, and sometimes dangerous jobs in the physical world, whether it's on a factory floor or in a warehouse. This is AI with hands and feet. Okay, but if building AI software is expensive, building its body is, well, it's astronomically more so. There's an old saying in Silicon Valley, hardware is hard. And let me tell you, when it comes to physical AI, that is a massive understatement. The challenges are physical, they're financial, and they are incredibly complex. I mean, just look at these numbers. Global data center capital expenditure, that's just the cost of building the buildings, is estimated to be nearly $7 trillion. And OpenAI by itself has spending commitments of around $1.5 trillion. Your brain almost can't process numbers this big. We're talking about the single most expensive infrastructure build-out in all of human history. And believe me, it is not just a money problem. There are very real physical bottlenecks we're running into. We're facing a looming power crisis, with these data centers demanding absolutely shocking amounts of electricity. There are shortages of specialized components, and you can't just snap your fingers and build a new power grid. That stuff takes years of permits and construction. This really puts that power problem into perspective. OpenAI alone is on track to consume the energy equivalent of 26 nuclear power plants. Just let that sink in for a second. 26. And that's just to run the software. That's the energy bill for the AI mind. And that's before we even start building its body on a massive scale. All right, so let's pause for a second. We've got companies spending trillions of dollars, facing these massive physical challenges. And in a lot of cases, they have little to no revenue. So that leads to a pretty critical question. How on earth do you figure out what these companies are actually worth? I mean, this is the million-dollar question, right? Or maybe the trillion-dollar question for investors looking at this space. Your traditional metrics like price to earnings or price to sales, they just don't work when there's no E or S to measure. You need a completely different framework, one that looks way, way out into the future. And that framework is often something called a discounted cash flow model, or DCF. Now don't worry, we're not going to get lost in a bunch of spreadsheets here. The concept is actually really simple. It basically says that a company's value today is just the sum of all the cash it's ever going to make in the future with one little adjustment, because a dollar tomorrow is always worth a little less than a dollar you have in your hand today. Now, I know it might sound complex, but the basic idea is really straightforward. Because these companies have no revenue today, you have to look into the future. You estimate all the cash they might generate someday, you account for the huge risk that they might just fail, and then you add it all up to get a value for today. The real trick, and where this all gets really interesting, is in how you estimate those future cash flows. And this is where we get the new blueprint for valuing these robotics companies. Instead of trying to forecast how many robots they'll sell, we forecast the value of the work those robots will do. Think about it this way. If one robot can do the same job as a human who earns $50,000 a year, well, that robot is generating $50,000 in economic value. Those are your future cash flows. The company's value becomes a function of its economic impact, not just its sales. And of course, the second you start talking about displacing labor, you run headfirst into one of the biggest, most heated societal debates of our time. Is this new wave of physical AI going to cause mass unemployment, or is it actually showing up just in the nick of time to solve a totally different kind of problem? This quote just perfectly captures the paradox that we are living in. On one hand, we have this deep-seated fear that automation is going to make human workers obsolete. But at the exact same time, demographic trends, aging populations, lower birth rates in developed countries, are telling us we are hurtling towards a severe worker shortage. Both of these things can't be true, or can they? The truth is probably somewhere in the middle. Let's just look at the raw numbers. The problem? A projected global labor shortage of 100 million workers. The potential solution? Humanoid robots, with production capacity that could hit 1 million per year by 2027. But the current reality on the ground isn't really replacement. It's what the sources are calling superstaffing, where AI acts as a tool to make the workers we already have more productive, not get rid of them. For now, it's all about augmentation, not automation. So, this brings us to the end, to the big one, the ultimate high-stakes question. We've seen the hype, the insane capital spending, the physical roadblocks, and the societal paradox. So, what does it all add up to? So here's where we are. We're standing at a crossroads. On one path, this is the birth of a new economic engine, one that's going to supercharge human productivity for the next century. On the other path, it's a historic capital trap, a $7 trillion mirage that's just too expensive, too complex, and way too power-hungry to ever really pay off. The answer isn't clear yet, but how we navigate that very question is going to define our future.